Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you how to use the LEAPS option strategy in order to help you grow your portfolio consistently and exponentially over time. Now, if you're one of those out there that's struggling to grow your small account portfolio, or you're working that 9 to 5 and you want to use options trading in order to get an extra income to supplement that 9 to 5, then I've got good news. You so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. Now, for today's video, I'm going to be showing you the LEAPS option strategy. I'm going to show you how to use this LEAPS option strategy in order to make consistent income and how this is going to help you grow your portfolio exponentially yet safely over time. Now, what is a LEAPS option? LEAP stands for Long-Term Equity Anticipation Securities. It is a mouthful, hence we use the acronym LEAPS option. Now for today's video, we're going to be using none other than everyone's favorite stock, which is going to be NVIDIA, ticker NVDA. Now you guys know how we do it on this channel. We're going to go ahead and get down and dirty with options. And to do that, we're going to go ahead and hit create NVIDIA options in order to open up the option chain. Okay, so here we are on the option chain. Now, before we get started, I always require that all my subscribers, my viewers, do themselves two favors. Favor number one, always make sure to do your own due diligence before investing. And favor number two, always make sure to have an exit strategy before entering any options contract. That being said, let's go ahead and dive into the option chain. Now, for those of you new to options trading or you're new to the channel, this area down here is going to be what's known as the option chain. The option chain helps you to make a very informed decision about what contract you want to get into. Now, a LEAPS option is going to be a long out expiration date contract. So, to get started, in order for you to acquire a LEAPS option, you're going to go to buy, then you're going to go to call. Now that you have buy and call, you're going to go ahead and choose your expiration date. Ideally, for a LEAPS option, you want to choose an expiration date of 365 days or 1 year or more. So that's going to give us the March 20th, 2026. Not quite a year, but it's going to work for this video. Let's go ahead and select that. And then now, in order to maximize the efficiency of this option strategy, it is highly advisable that you choose your strike price below the current share price. As you can see here, the current share price is $112.40. So now we're going to go ahead, we're going to go below the share price in order for us to acquire our strike price. Now, just for the purposes of doing this video, I will be selecting the strike price of $100. That's a nice round figure. Now, with the strike price of $100, you can see strike price to the top here. That's going to give me a delta of 0.72. We're going to get back to the delta in just a second. So, with the $100 strike price and with a 0.72 delta, we're going to have to pay. The reason why we're going to have to pay is because we're going to be buying something. The amount we're going to have to pay is going to be $30.65. Now, $30.65 in the real world is going to amount to $3,065. So this option strategy is going to work perfectly if you're trading with a small account. Now hear me out. If you were to buy 100 shares of NVIDIA right now, that would actually cost you $11,240 because you're going to have to acquire 100 shares at $112 per share. By utilizing the LEAPS option, you're now able to control 100 shares of NVIDIA stock at just fractions of the total cost, which is going to be $3,065. Let's go ahead and click into it. As you can see here, this is known as a long call or a LEAPS option. Now, before I go ahead and explain the LEAPS option to you, let me go ahead and give you some additional information that's guaranteed to help you out when selecting your strike prices in order to purchase your LEAPS option. So now we're going to go ahead to the secondary option chain, and you do that by hitting into the price. Now, I did go over the delta in just a few seconds prior, but let me give you a little more explanation. The delta is of extreme importance. The delta helps us out several ways. For this case, if you were to purchase a LEAPS option, the delta is going to tell you that with every dollar increase or decrease with this share price, the entire overall option is also going to increase or decrease by whatever the delta is. So let me break it down to you in layman's terms. If the share price were to go from 112 to 113, then this overall contract is no longer going to be 30.65, it's going to be 30.65 plus 0.72. That is one way the delta helps us out. Please keep the delta in mind. I will revisit it before the video is out. Now, the next thing I want to bring to your attention is the implied volatility. When buying your LEAPS option, always try your bestest to make sure you get an implied volatility of between 50% to 100%. That is like the sweet spot when picking up LEAPS. The reason for that is that any implied volatility between that range gives you a very medium risk, and it helps you out with the other options that can be done with your LEAPS option. And we're going to get into that as well. The other thing I want to show you is the open interest. The open interest tells you how many people actually acquire this $100 call. So it tells us more than 9,000 people like this call here at the current price it is. Now, we're going to go ahead and I'm going to explain the LEAPS option to you. So, like I mentioned, the LEAPS option is a long out expiration date. So once you acquire a LEAPS option in your portfolio, there's a couple things you could do. The most important thing you could do with a LEAPS option is do nothing. The reason for that is that, once again, it is a long call, meaning you have an entire year in order for the stock to move in your favor. So, as time passes, the share price is going to increase, and then this here is going to increase, and your overall LEAPS option is going to increase in well, and that's how you're going to gain the majority of your money. Now, very key to know, no one actually lets the LEAPS go all the way to expiration. In my personal experience, 3 months before expiration, that's when theta works against you. Theta is going to be time. So try your best to either close out your LEAPS option, or you could do what I do. You can always roll it out to a further expiration date. Now, the other thing you could do with a LEAPS option, since you have it in your portfolio, why should it just sit in your portfolio rent-free? So that brings me to the next strategy that can be used with your LEAPS option. Now, assuming you have a LEAPS option in your portfolio with NVIDIA, now we're going to go ahead and we're going to use that LEAPS option in order to make it pay us rent. So now we're going to go ahead and we're going to choose our expiration date a bit closer right after we change the strategy to a sell and a call strategy. Remember, the LEAPS option was a buy call. Now this new option strategy is going to be a sell call. We're going to go ahead, we're going to choose April 11th strike date, which gives us about 16 days to expiration. Feel free to choose any expiration date that works for you. There's only one person that can make the best decision for your portfolio, and that person is definitely you. So April 11th it is. Now we're going to go ahead and we're going to choose our strike price above the share price. Once again, the share price is 112.44. So we're going to go up now and we're going to choose a strike price that works for us. Now I'm going to be going with the strike price of 130, and I'm going to be doing that for several reasons. One reason is going to be I sell options and I like to make income selling these options. The other reason, which is the most important reason, is that you want to sell at a very high strike price, because at a very high strike price, that's where you get a high chance of profitability, which means there's a high chance that the trade is going to go in your favor. Now, with a high chance of profitability of, let's round it up to 94%, that also means there's a 6% chance this trade goes against you. Now, although it's 6% chance, I still have to mention it. So With the $130 strike price and a very high chance of profitability, the 94th percentile, now we're going to be receiving income. The income we're going to be receiving is going to be 0.34 or $34. Once again, we multiply 0.34 in option terms. We're going to multiply that by 100 shares, and that's going to give us $34. You could continue to do this consistently for about 6 to 9 months, just accumulating options premium, and that is how you're going to grow your account portfolio safely and consistently over time. Let's go ahead and click into it. Now, this new option strategy is known as the covered call option strategy. Remember, you do have a LEAPS option in your portfolio. The best thing to do with your LEAPS option is to leave it alone until the share price has appreciated, until it meets your liking. Then you could close it out and lock in your investment gains. If you do insist on making some extra kind of money, then consider the covered call option strategy. Now, for those of you that are new to options, whenever you use a LEAPS option in your portfolio in order to sell consistent covered calls, that creates a new option strategy known as the poor man's covered call. It does not mean that you're poor. It just means that you're able to control 100 shares of whatever stock you want to trade and then use that controlling 100 shares in order to make consistent income. Now, the reason why I would choose a high price of $130, because the most important thing, once again, I have said this several times throughout the video, you want to keep the LEAPS option in your portfolio as long as you can. The majority of the income you're going to get is from the stock appreciating. Now, let me just give you a brief example of how much you stand to gain. So, let's say on April 11th, which is 16 days out, let's say the share price moves from 112 to 130, which is highly unrealistic, but humor me. Let's say that happens. Now you're going to realize some investment gains because now this share price is going to go past your strike price that you chose, which means you're going to now be forced to lose your LEAPS option, and you're also going to lose this strike price. Remember that 6% chance I told you about? Well, it actually materialized, and now you're going to be forced to sell at this share price. But this option strategy is known as a win-win option strategy because once both these option strategies are closed off, meaning the LEAPS option, you're going to lose that, and the covered call, you're going to be forced to close that. The difference between the 130 price here and the share price, we assuming you got the LEAPS option at this share price, the difference between them is going to be your income. So that difference is now going to be $18. Once again, we are dealing with options contracts here. So you're going to multiply your $18 difference by 100, and that's going to give you $1,800. Now, I also did mention to you the key role that the delta plays. Now, the delta, you're going to multiply your $1,800 by your delta, which is going to be 72%. Remember, it was 0.72. Now you're going to multiply that. Once you multiply your $1,800 by 72%, which is your delta, that's going to net you $1,296. So let's just say all this materializes in just 16 days. Then you stand to gain almost $1,300. Now, the reason why I like to choose a high chance of profitability is that what I just explained to you. I prefer to make $1,300 than to make $40, $48, or $57 and compromise the amount of money I could receive overall. Now, if you want to make some more income, that's fine as well. Remember, it is your portfolio. Feel free to reduce your strike price. Let's say you're going to go down to 128 now. What that's also going to reduce is that it's going to reduce your chance of profitability. You're going to move now from 94% down to 91%, which is still pretty high. So remember, all these are based on your own personal risk tolerance. However, although the strike price has been reduced and the chance of profitability has been reduced, the good thing is your income is going to increase. So, like I said, you need to make that decision. For me, I always focus on the two most important things. Number one is to make sure to keep the LEAPS option in my portfolio as long as possible. Once I'm able to do that, then I'm able to sell consistent covered calls, which is going to allow me to bring in consistent income, which allows me to grow my portfolio safely and consistently over time. Now, the LEAPS option is one of the best option strategies that I use in my portfolio, hands down. It has allowed me to grow my portfolio exponentially over time. If you guys have any question concerning the LEAPS option strategy, the covered call option strategy, or the two of them combined, the PMCC, then let me know in the comments below. Now, I want to ask you guys a question. Do you guys think that Nvidia is a good stock in order to do the LEAPS option? Once you answer that, then let me know if you want me to do an analysis of which stocks are the best stocks in order to do the LEAPS option. Now, thanks for watching the video. Subscribe to the channel. If there's anyone out there struggling to grow a small account portfolio, remember that is my specialty. I do help individuals grow a small accounts portfolio safely and consistently over time. Also, remember to hit that notification bell. That is going to allow you to get an alert when I post a video. I do post pretty often. Now, until the next video, keep pushing your investments.